Hey everyone, this is Lonnie Matthews with another video for you in the series of investments. So I did a couple of videos a while back. One, I talked about the 4 things that you need to know or do before you invest. And hopefully that was a good foundational part for you. And then I followed up with another video called What is a Stock? And in that video, I kind of explained the whole concept of a stock and basically how you're taking ownership in a company and then being a part of what that company is doing. And as that company is successful and the value of that stock goes up, that's how you, the individual investor, tend to make money. But in this video, I wanted to talk about what is a mutual fund. So actually, it's going to be 2 separate videos. This particular video is going to be what is a mutual fund. We want to discuss, what exactly a mutual fund is, and then the next video that I put out after this one was called how mutual funds work. So in that video, I plan on just walking you through some detailed things about how you actually make money in mutual funds. But for right now, in this particular video, I want to discuss what is a mutual fund and where do they come from? Now, if you remember in the stock lesson, I said that, you buy stock in a company, the company does well, and then as the company does well, the value of the stock goes up, and that's how you make money. I also said that in order to make money in stocks, you really need a lot of stocks. In the example that I did in the last video, it was Coca-Cola stock, and Coca-Cola was selling for $49 a share at that moment. And I said that in order to make see a significant gain, then you need about 100 shares of stock. So what that equates to is if you own 100 shares of stock, say Coca-Cola, for every dollar that the stock goes up in value, you actually earn $100. That's one of the ways you can make money in stocks. And so your hope is that you buy it at one price and it continues to go and grow at another and up to another price. And then every $1 increase means $100 to you. And we also said in that example though that at $49 a share to have to buy 100 shares of Coca-Cola stock, that's like $4,900 plus any brokerage fees that may be involved in that process. And that's a lot of money. And not a lot of people just have, $4,900 just laying around that I don't need and can't use, don't need to use for the next 5, 10, 8 years, right? If you do, great, that's exciting. But if not, then hey, you still can get into the stock market with less than a $4,900 initial investment. In fact, you can get into a stock market with as little as $250 or $100 a month to get started. And how do you do that, you may ask? Well, mutual funds. So now that we've kind of discussed, the difference between buying stock individual, let's get into, what a mutual fund is and how it works. So basically, imagine if you have a lot of individuals who have smaller sums of money. Somebody might have $1,000 they're willing to invest. Someone may say, hey, listen, I don't have $1,000, but I got $100 a month free that I can invest. Would love to be a part of this thing. So what happens is all of these people put all of their money together in this big pool of money, right? Giant pool. I'm talking billions of dollars. And then the individuals have mutually decided on the type of investments that they would like their money to be invested in. And that's what we call a mutual fund, because this thing is mutually funded by a bunch of people. So imagine, if you will, a bunch of people. Some people got thousands of dollars. Some people got, $100 a month. They're willing to add to this thing. And it comes up to some billions of dollars. And we all agree that we only want our money to be invested in companies that are solid and have been around a while, and they are staples in the U.S. economy. Let's just say, for example, companies like Home Depot, Walmart, Amazon, Apple, just companies that have been around a while, Clorox, just you name it, the airline industry, just all the different types of industry, the banking industry. We want the best of all of these industries, and we want to invest our money in those companies and those companies only. By the way, that would be like a blue chip mutual fund, right? The blue chip companies. And so we all mutually agree that's how we want our money invested. We put our money together and we turn this pool of money over to a guy that's called a fund manager. Now, let me tell you, this guy's been on Wall Street for years. I mean, years. He knows he's forgotten more about financial investments and things than we will ever remember, right? Because that's what he does. And he's got a lot of experience. So he goes and we assign him as the manager of this pool of funds. And that fund manager will then hire analysts. And these are analysts for each different industry. And all these guys being the unisex term, do all day, every day is they analyze companies, right? Now imagine if we got $100 billion, $100 million that we're trying to invest. That means we can buy significant amount of shares in some of these major companies. Unlike if you were trying to buy shares in Amazon at $600 a share, I mean, 100 shares would be like $60,000. Who's $600,000? Who's got that? But we do, because we got, $100 million with this mutual fund now, and they're able to go in and buy nice big chunks of stock in some of the most famous and the solid companies, and they're going to buy these big chunks. And when these companies go up in value, so does the value of our mutual fund, because it's made up of these different companies. Here's another thing that the analysts get to do that you and I don't. Because they have hundreds of millions of dollars that they're using to go out and buy stock into these companies, the companies give them an ear. In other words, an analyst can go and say, hey, listen, Amazon, we're thinking about buying a big chunk of your stock. We'd like to come and meet with you, meet with the senior leadership, meet with the, the folks that's going to run the company to get some ideas of the things that you have going on so that we can make sure we make a good investment. You and I, not so much. Yeah, you try to go talk to Jeff Bezos saying I want to buy 100 shares of Amazon and see what he says before or after you get arrested. I don't know. Just saying. So analysts, they get an opportunity to go out and talk to these companies and get the 411 and find out what's going on so they can make an informed investment. So that's another neat thing about mutual funds. So now what happens is we take our pool of money, turn it over to this fund manager. The fund manager hires analysts. The analysts will then go out and find the best companies to fit the profile that we mutually agree upon. And then they will go out and invest the money on our behalf. And all you have to do now as a consumer is just kind of sit back and relax and let the investments continue to do what they do. But the thing is now you own shares of Coca-Cola, you own shares of Home Depot, Clorox, GE, Amazon, Apple. All those, most mutual funds will have anywhere from 180 to 300 companies in there, right? Some companies, they own more of it and some they own less of the shares, but nonetheless. So now what happens as these companies go well as a collection, then the value of the mutual fund goes up. And the mutual fund, you can buy it in shares just like you would stock. But this one share consists of hundreds of companies and not one share of one particular company. So that's what a mutual fund is. And that's how you and I can make money. And it's really designed for smaller investors, people like you and I who, hey, listen, I don't have a $70,000 to invest, and nor do I have the time. So even if you had the $70,000 to invest and you were to go out and buy a portfolio of stocks, you'd have to sit down and manage that portfolio of stocks, right? That means you'd have to understand when to pull it out, when to not pull it out, when to move things around. I personally don't have the time to do that. Even if I did have, $100,000 to invest, I just wouldn't have the time, nor the foresight or the knowledge to get in front of, oh, well, this company is going to do well. That's what they pay the analysts in mutual funds to do, right? Just kind of act on our behalf. So you can get into a mutual fund, like I said, for as little as $250 a month, $100 a month. Most mutual fund companies will allow you to start one. Now, where do you get one from? There are several places you can get a mutual fund from. One, you could go to an advisor, right? And then have them sit down, and which I would recommend anyway. If this is something that's very, very new to you, is sit down with someone, go to an advisor, have them walk you through this process. At least you kind of know what a mutual fund is. Have them talk to you just like I'm talking to you right now and not over your head and just trying to force you into something. Or you could just go online to like a fidelity.com. You can go to a Vanguard. A Vanguard would be a mutual fund company that mirrors the New York, the indexes, meaning they don't really get into a whole lot of other stuff. They just mirror the index. However the market does, they do. Some of the other traditional mutual funds, they tend to manage more companies inside the mutual fund. Now, for instance, if one of the companies in the mutual fund is not doing well, then that's for the analyst to decide, hey, let's pull this thing out, or let's replace it, or let's just watch it, right? That's the beauty of mutual funds. So that's why I like mutual funds. You can get started. Mutual funds come in all different categories. You can get an aggressive fund. If you're saying, hey, I want to take a little bit more of aggressive approach. So you're going to pool your money with other people that feel like they want to take an aggressive approach as well. So the fund manager now and the analyst will then go out and find companies that have a more aggressive approach to doing business. Maybe these are startup companies and they're going to expect to do really well. So, you'll probably get a better return than something that's a safe company mutual fund. So some of the things that you get by individually by investing in mutual funds is, number one, you automatically get diversity, meaning your money is spread out over so many different companies, out of so many different industries. You really diversify your investments right away by getting a mutual fund. The number two thing you get with mutual funds is you get a professional. Someone that is a professional to manage this fund for you, keep eyes on all the companies in there for you. And basically you just sit back and relax and get the returns. You get a lot of different choices when it comes to mutual funds. You're basically able to leverage a small amount of money to be able to get more money invested in several companies, as opposed to if you had $5,000 and you had to choose one company. And then mutual funds are easy way in and easy way out. It's easy to get a mutual fund. You can have it set up to come out of your bank account where they take $100 a month and draft it and invest it for you. You buy as many shares as you can for that $100, whatever the share price is. You can sell mutual funds just as easy. If you go online to your account, you say, hey, I want to cash out $500 worth of my mutual fund. What's going to happen is at the end of the trading day, they're going to look at the value of that mutual fund, determine what the share price is, and they're going to sell as many shares as they need to get you your $500. And it's done electronically, usually in your account in the next day or two. So if you sell, say, on a Monday, when the market closes at 3 o'clock, they're going to value the mutual fund, figure out how many shares to sell those shares. By Wednesday, the money should show back up in your account. So it's very liquid, easy for you to get in and out of. Great way to kickstart your investment journey. So I certainly would recommend starting with a mutual fund, just trying to get your feet wet as you continue to educate yourself. Mutual funds comes in all different shapes and sizes, different flavors, different risk tolerance. So if you're not sure, again, sit down with someone and have them walk you through, maybe do a risk tolerance assessment for you. So that's a mutual fund, guys. That's what it is. The next video is going to be how mutual funds work. So thanks again. I'm going to keep putting these videos together. I hope they're helpful.